these e-com businesses have gone from a situation where private equity looked at it and said, boy, that looks really risky, single channel, to, boy, I can now see that these are great businesses. These are great businesses and that I can scale it. And now I can buy, call it an Amazon-centric e-com, DTC e-com business, and I can build it up. And by the way, I can look at more of a DTC where I'm selling through my website. I might be looking at other channels to diversify. I might be even looking as far as retail and creating more of a hybrid model. But they can see that growth path. There's been many successes.
Welcome to the Ecomm Breakthrough Podcast. Are you ready to unlock the full potential and growth in your business? You've already crossed 7 figures in sales, but the challenge is knowing how to take your business to the next level. Join Josh Hadley, an 8-figure e-com business owner and investor, as he interviews highly successful business owners. Get ready, because you're going to learn specific actions you can take today to help your business reach its full potential and leave a lasting impact on the world.
Welcome to the Ecomm Breakthrough Podcast. I'm your host, Josh Hadley, where I interview the top business leaders in e-commerce. Past guests include Kevin King, Michael E. Gerber, author of The E-Myth, and Matt Clark from ASM. Today, I am speaking with Trever Acers. Trever is the founder and one of the managing directors at Objective, a middle market investment bank. And we are going to be talking a lot about how to maximize your business for a premium valuation that will not only help if and when you decide to sell, but to help you stay in business for decades to come. This episode is brought to you by Ecomm Breakthrough, where I specialize in investing in and scaling 7-figure e-commerce companies to 8 figures and beyond. If you're an ambitious e-commerce entrepreneur looking for a partner who can help take your business to the next level, my team and I bring that hands-on experience, strategic insights, and the resources needed to fuel your growth. So if you or someone you know is ready to scale or looking for an investment partner, reach out to me directly at josh@ecommbreakthrough.com. That's ecom with 2 M's. And let's turn your dreams into reality. But today, I am excited to introduce you all to Trever Acers. Trever is the founder and one of the managing directors of Objective, Investment Banking and Valuation, and is focused solely on the investment banking group, which offers sell-side advisory. Trever has 20 plus years of investment banking, acquisition, and strategy experience advising middle market companies on transaction execution and strategy. So with that introduction, welcome to the show, Trever.
That's a lot. Thanks, Josh. Excited to be here.
Trever, super excited to have you here to kind of give us a lay of the land of what's going on specifically in the e-commerce space with acquisitions right now and buying and selling. What do multiples look like? But I love that you also are not just solely focused on e-commerce. You also are advising other middle market businesses and seeing multiples in very different segments as well. And you're seeing some up, some down. So I'm interested to kind of get your take on the market right now as we record this fall of 2024 here. Where are we at specific to e-commerce and then maybe the broader market as a whole?
Yeah, it's been really interesting. So I led our consumer practice for a good number of years. And one of our areas of expertise we spent a lot of time is e-com, both in B2B and direct to consumer. And, we're seeing some really interesting shifts. We had talked a little bit about this aggregator model that had been very popular especially in the DTC space, but we saw it in B2B as well. We've seen I would tell you, we've seen I wouldn't call it necessarily a decline because there's still a lot of them out there. But they're really not consistently as a whole, really often the most attractive acquirer. And I think some of the challenges that they've had is if we go back 7 years ago, a little bit further, what we saw is that a lot of these e-com skills were very, very limited in terms of how many people had them, right? And so as that has changed, as e-com, that skill set has continued to have expanded in the number of people that have it, really that magic, that ability to say, hey, I can take your business and help you scale because I know what I'm doing, everybody else doesn't. That value proposition has been diminished. There are people, like yourselves, who are exceptionally good at helping people grow their business, their e-com businesses. And those are services that you can hire. And so that value proposition has been diminished. In addition to the fact that the value prop of, hey, I'm going to buy you, and I'm going to give you all these massive amounts of synergies, is really, really hard. GE talks about the fact that when they make an acquisition, they expect to have negative value. And I think that's real. I think it's when someone buys you and says, hey, we're going to rip out all your systems and put in our systems because we know what you're doing. That's a tough model. I think there's a lot as private equity acquirers have become more and more interested and comfortable with e-com, especially Amazon-centric e-com businesses. We're just seeing the range of acquirers expand dramatically. And as such, they're willing to pay a lot more than aggregators were. And so I think that right now it's a really robust market for e-com businesses. We've never seen private equity more comfortable in looking to these companies. But there's some specific equations that they're looking for, a set of characteristics in an e-com company that makes it exciting.
Awesome. Well, I think that part's fascinating. And I think that maybe the aggregators maybe led the way to help maybe bring a little bit more appetite from the private equity standpoint. So we know the issue with the aggregators. Overall, it seems like multiples are down, but yet you're telling me, Trever, that like, hey, there's actually some private equity willing to throw some decent multiples at things right now. So maybe tell me, what are the brands or the types of e-commerce companies that these private equity companies are looking for and willing to pay a premium for on the multiples?
Yeah, so let's focus first on DTC, right? The consumer segment. If we compare 2019 to 2020 through 21 to today, it's reasonable to say that the level of activity and quote unquote multiples are down in the DTC space. That's really a function of the fact that we saw this like euphoric time, like an amazing, right? 2019, 2020, 21. We had COVID and we had this huge maturation within e-com, shifts in customer spending, customer behavior. That was spectacular. We're now seeing a normalization of a lot of that, where the technology is much more ubiquitous. The capabilities are now and we're getting a maturation in the way that we can reach out to customers. Right, we're having more and more channels, greater diversification, and a real institutionalization of that. If you look at, for example, TikTok and how e-com companies have been using TikTok 3 or 4 years ago compared to today, it's an amazing maturation. So what we found is that buyers are cautious, right? They're cautious and they're thoughtful about, boy, where is the macro economy going and what's going to go on in consumer spending. We know there's shifts. If you think about that economic pyramid for a second, we know that more than a year ago, we saw massive shifts in the lower third of the consumer spending, and we're seeing it continue to walk its way up. Where we're seeing now luxury brands reporting changes in revenue. So look, acquirers are certainly watching that and are concerned at the macro. However, these e-com businesses have gone from a situation where private equity looked at it and said, boy, that looks really risky, single channel, to, boy, I can now see that these are great businesses. These are great businesses and that I can scale it. And now I can buy, call it an Amazon-centric e-com, DTC e-com business, and I can build it up. And by the way, I can look at more of a DTC where I'm selling through my website. I might be looking at other channels to diversify. I might be even looking as far as retail and creating more of a hybrid model. But they can see that growth path. There's been many successes. So I would tell you, in general, it is a good market. Maybe more refined, there are certain segments, mostly because of the macro economy, that are challenged, right? Have nothing to do with the acquirers. But if you look at apparel right now, for example, e-com apparel is having a hard time. We're seeing shifts in consumer spending. We're seeing a consistent dependence on discounting. We're seeing margin decrease there. It's hard. This might be the time for many apparel brands to kind of keep their head down, keep growing, keep working on genuine organic customer interactions. That's going to pay off here in the near future. Other consumer products, especially health related, if you look at health and beauty, doing very well. We expect to see some big IPOs this year in the health and beauty space. I think that's going to be a continued signal of the fact that a lot of customers have shifted their acquisition trend, their customer trends towards a lot of self-health, and that they're going to spend their incremental dollar that they have on health and well-being in comparison to some of these other products that they may have been more popular, a nice-to-have product in a 2019 timeframe. So it's an exciting. It's an exciting space in the DT, the direct to the B2B segment. I think is very different. I think in the B2B segment, you're certainly impacted by the macro economy, and we're seeing if your customers in their industry are having growth challenges, that can be a problem. But you look at healthcare, e-com businesses focused in the healthcare segment, killing it right now. They are doing a really nice job, especially as healthcare organizations post-COVID redo how they think about their procurement. There is a lot of opportunity for e-com businesses focused in that B2B segment. Strong customer service, really quick delivery, strong response. Beautiful for if you think about that Amazon platform, right? It plays right into that equation. So we're seeing really good multiples in that space.
Interesting. That's fascinating. And, I agree with you. I think we have seen that on the beauty side, health, right? And even supplements, still fairly strong. So I guess this would be my question then, Trever, as you work with, other brands and help provide them strategy to exit, to increase their valuation. Give me a roadmap that you're giving to a lot of these brands that might come to you that says, hey, I want to exit in the next, 2 to 3 years. What do you do to help them become more attractive, especially to private equity?
Yeah. And so it's very common. We'll work with companies up to about 3 years prior to sale. We find that we can start conversations around 5 years, but at 3 years, it starts to be real in terms of, okay, there's some things I can actually do that aren't sort of high level guidance, right? Boy, someone tells you to keep your accounting clean. Okay, I appreciate it. I'm an entrepreneur. I'm trying to grow my business. In that 3-year window, we're seeing really more actionable things about how I should be thinking about structuring my business. There's also some guidance there, and not only in terms of characteristics that acquirers are looking for, i.e. things that we can do to make ourselves more attractive. But I think the other thing that we're teaching them that I would say is even equally, if not more valuable, is how to respond to all the unsolicited interest from acquirers. And that's, if we talk about, we're talking about at the start here about, these really trying to focus on specific actions, right? What can I take away? If I'm listening to this podcast, what can I take away? And so if there's 2 things you can hear, I want to highlight those. So here's one of them. When we're talking to business owners in this e-com space, the comment we say is, look, M&A has become a normalized business activity. 20 years ago, M&A was this strange, weird thing. A call you got, you didn't talk to anybody about it. You were scared. No one knew what they were doing. We're in a new world. M&A is now a very, very common growth strategy for acquirers. We've got private equity, there's more than 2,500 active private equity firms in the United States. They're calling everybody. I get calls. Trever, we want to buy your business. I have to remind them, you realize we're an investment bank, right? So there's a lot of junk email, but there are also really, really valuable calls. People calling you unsolicited. I want to buy your business, and how to respond to those. So this is the thing you can do here. The greatest risk in those calls is wasted time. And it sounds very stupid, but let me quantify it for you. So I'm an e-com company. I'm at 8-9 million. As I reach that $10 million revenue mark, there tends to be an increase in buyer activity. You get on their radar. Now they're interested in buying you. The reason being at 20% margins or somewhere thereof, that puts 2 million of EBITDA at 10 of revenue. And at 2 million of EBITDA is a stair step for private equity interest. So that's where we're getting more and more calls. And the challenging ones are from a strategic you've known, someone in the space, you respect them. Wow, so-and-so is calling us. Boy, I really like that brand. And now this can happen in private equity as well. Boy, this private equity firm just called and they told me they want to buy my business and really excited. What happens is, as entrepreneurs, we get that call, we're stoked. We are so excited. We're flattered. We feel good about ourselves. And so our desire, and it makes us excited. Boy, I wasn't even thinking about selling yet. But they're out there, they're talking to me about, or creating this image in my head that I can have a lot of money. This would be a wonderful thing. I should spend time on this. And so what the entrepreneur then does is they talk with the buyer, they send an NDA, they send them their financials, they have more and more calls. We're now let's call it 3-4 months into a conversation. And maybe then we get an offer. And we look at the offer like, wow, that's not even close to what I would need. And what we figured out is you could likely have identified that buyer was going to disappoint you, not because they're bad people, but because their needs and your expectations are not aligned today. You could have identified that within a couple weeks. Instead, we just spent 4 months. And so you could say, well, no big deal. I didn't sell it. We kept going. That's okay. I'm not concerned so much about the confidential information we just sent them. I don't believe that high-level financials really include tons of confidential information. In fact, I would advise, companies should always talk to their attorneys and get their own advice. I'd say, look, sharing revenue and earnings information even before you sign an NDA is a good idea. And the reason is, if it's not a fit for them, I want to get them off the hook, right? I want to get them to leave. And this is why, if I went through that 4 months of brain damage and talking with this company, I'm so excited. We're going through it. They keep asking me. And what's happening is, instead of focusing on the company, instead of focusing on growth, a larger and larger percentage of mind share of possibly the most valuable person in the company, right? The CEO owner, has been focused on something that had if we were doing it right, would have known that was a poor waste of time. What that's going to do is cost us. So if we were thinking we were going to be, call it $2 million of EBITDA, and instead we ended up at 1.5, because we were just so focused on what was going on. So that $500,000 of EBITDA at 7 to 10 times. So that's 5 million at 10 times. That's $5 million of enterprise value that we just destroyed. We just threw it away because we didn't have a methodology to aggressively disqualify that buyer interest, to shake them off the hook, right? If this isn't the fish I'm looking for, I want them to go away. I might want to keep a relationship. I might want to be nice to them, right? So that we can talk with each other later on. There's some strategies there. But I want them to allow me to focus back on growing the business. And that's the methodology we often talk to entrepreneurs about as they go through this. Boy, we're 3 years out. And the key criteria are knowing what you want. That's the first thing. We need to understand what success looks like. And that might be something to the effect of, boy, if I'm going to sell my company, I'd want at least X dollars in after-tax cash at closing. That's the key metric. And what I mean by that is not the top line. Top line's a great number, but that doesn't count. I need after tax. And then the top line number often includes a dollars today and a potential dollars tomorrow. We don't make decisions on potential dollars tomorrow. We make decisions on dollars today. So after tax cash at closing, what does that need to be? So if my number is $10 million of after tax cash, whatever state I'm in, you can figure out what the top line dollar is, assuming that it's, call it 70% cash, 20% earn out or rollover or whatever the other may be. You can start doing the math and basically saying, as you're talking to this acquirer, hey, by the way, I'm so flattered you called me, really excited. You guys do amazing things. By the way, here's my revenue and here's my earnings. And we get a lot of inbound interest. then I don't think we'd probably be interested to sell for anything less than X. And what I'm doing is I'm trying to shake them off the hook, because that X dollar, that valuation that I tell them, is probably a function of where I'm going to be in 3 years. I'm executing a 3-year growth plan. I'll tell them I'm executing a 3-year growth plan. We probably wouldn't usurp that plan. We probably wouldn't preempt that plan for anything less than X dollars. And what you're doing is you're recognizing that that might be a tomorrow price, right? But what we're doing is giving them, as a good partner, we're giving them a buy now opportunity. Yes, it may be a premium, but I told you why it's rational, because I'm executing a 3-year plan, but that's my buy now price. And if it's ridiculous to them and they look at it and say, boy, we just can't pay that. Great, that's wonderful. If they're a great partner, let's keep a relationship. Let's keep in touch. Maybe there's a partnership opportunity here. That's wonderful. We're going to keep executing, and that we go back to focusing on our business. And if they say yes, wonderful. What we've done by telling them that number is we've created a floor and not a ceiling, because we told them we get lots of interest. So boy, at that 20, it would have to be $20 million or more. Okay. Now what we've done is said, if you're interested, that buy now price is $20 million or more. The key positioning there is, if I tell you that I'm going to sell you this apple for $1 and you're going to try to buy it for lower, you're never going to pay me more than $1. But by telling them that I have a lot of interest, which is true, and letting them know that's my minimum decision point, wouldn't do anything less than, I'm creating that floor, not a ceiling, and I'm allowing ourselves to basically disqualify any interest that comes in below that. I want them to very nicely go away, which is in complete conflict with what our bodies tell us, right? Our human body says, oh my golly, so excited, I want to keep spending time on this. Instead, we want to tell them the exact opposite. Let's find out if there's a real option for them to achieve success here together. Let's focus on it. But most likely, they're not going to achieve it. So let's try to shake them off the hook.
Yeah, I love that. So you recommend people understand what is their number that they want to meet. That's kind of like, this would be my dream, kind of exit. Set that down, and then kind of almost have like a pre-templated response that you can copy and paste whenever you get an email or outreach that's like, hey, we're getting a lot of interest. We're executing a 3-year strategy right now. We've got a X number of products in our product launch pipeline. We know we're going to be at X revenue in 3 years. So we're not entertaining anything less than $20 million.
Yeah, I'm a little hesitant to put that in an email, but I think in a communication, a verbal communication, I think that's a really effective approach. The other thing we do is we often, when we're starting to talk with a company, and when I say working with a company, most advisors do not get technically engaged until they start a sale process. We're very similar. So we'll work with a company 3-4 years before we technically get engaged. And often what the company will do is just refer us that inbound interest. And it's basically, hey, Trevor, will you have a conversation with X? They talk to us. I want to keep the CEO focused on growth. I'll talk with a company. I'm going to try to disqualify them, knowing what my client's objectives are. And if there's merit there, then I'll set up that call. But my commitment is to try to make sure that I only take that CEO's time if there's a high probability of achieving their objectives. And when we talk about those valuation objectives, I really want to clarify here. We talk about valuation, there's 2 numbers that are critical. The one is, what are we targeting, right? What's the number that we're shooting for? That's really important, because when people talk about valuation, that's often what they want to hear and want to talk about. Boy, I want to sell for, I'm at 2 million of EBITDA. I want to sell for 10. I want to sell for 20 million. That's what I'm targeting. Okay. But the next question that is for internal decision-making purposes is critical is what's my sell now number? What is that number that I'm actually willing to sell at today? Or I'm willing to hold it for $1 less. And if you're selling your house, most people would advise you, don't tell your realtor that, because they'll sell it for they'll sell your house for like $1 more than what you're willing to accept, because they're looking for a transaction. A really good investment banker's job is to not only deeply know your industry, but to maximize the outcome. That's what you're looking for. Someone who's not looking to run a standard process, but someone who really has some methodologies to maximize your value. And that's the key, is tell them what that number is, that decision number, so that they can say to you, boy, you know what? I just don't think at this point in time running a full market process makes sense, because there's a high probability that most of the offers don't meet your objectives.
Yeah.
And they know that the cost of taking you through a market process and failing, yeah, it costs them a couple months of time. It costs you millions of dollars.
Yeah.
So really, you being thoughtful about that, using those metrics and being thoughtful about that is one of those key intelligence things that business owners need to have.
Love that. I think that is great, solid advice, so they don't get, caught up in the thick of thin things, for sure, and focusing on the growth of the business. So, Trever, my question would be, all right, so let's say our goal is to get to a $20 million exit. What are the things you're encouraging, entrepreneurs to do now? What are some of the best practices? What is private equity specifically looking for that we could start cleaning up in our businesses today?
Yeah, I mean, there's certainly an overlap, right, in terms of what private equity is looking for and what strategics are looking for. But I think private equity is a little bit easier and maybe a better lens to look through. And the reason is any strategic acquirer has all sorts of very idiosyncratic rationale. What are we doing in our business today? Where are we going as a brand? What makes sense for us? Which are really hard to solve for. Some of it you can see from the outside, some you can't. So instead, if we look at private equity, which is just a much more stable view of the world, I'm looking for companies that look like this. I think that's a better lens. And so I would tell you that one aspect is what we call single channel dependence. So if I'm only selling through Amazon today, is that a good thing or a bad thing? 10 years ago, private equity was very, very uncomfortable. Even 7 years ago, very uncomfortable with just a dependence on Amazon. I think that's changing. I think private equity really recognizes the maturity of the Amazon channel and sees that the history says that you can build a very sustainable business. The fears were, I don't own the customer, right? I don't think that's true today, right? I think you can own the customer and own that relationship and that experience, and yet still use Amazon as that channel. So I think that's going away. That being said, companies that have multiple channels, I've gotten exceptionally good at Amazon. It's not that I'm defocusing on Amazon. It's that I've found other channels. Maybe it's wholesale. Maybe it's distribution. Maybe it's retail. Maybe it's through my own website. That creates a diversification of sales channel, which is certainly an attractive characteristic for businesses. And this is one of those things. It's a great example of a characteristic that shows us that there's a difference between a great business as an entrepreneur and a saleable business, right? A great business creates consistent cash flow to us as business owners, right? What we're looking for in terms of a highly saleable company can be different. And this is a great example of where, sales channel diversification probably makes you much more attractive to acquirers as you grow, but may not necessarily create large amounts of incremental EBITDA as opposed to just focusing on Amazon. Some of the other things we see is a single product dependence. We see companies sometimes and they name themselves after the single product. And it's really hard as you think about that defining characteristic. So we see as somebody who sells a specific type of beauty aid or a specific supplement. And so what we're looking to do is we want to see companies who have shown evidence of the ability to expand their product offering. Take that contextual relationship they have with a customer and expand it beyond that one thing that they sold them first. And great brands consistently do this. So that's a real opportunity. We want to think about that product line diversification. The reason is the acquirer looks at it and says, great, you got it to call it 10 million. Where do I take it from here? How do I grow this, right? And so that allows us to have a growth story on my ability to expand that product line. I can sell more stuff to my existing customers, lowest cost of customer acquisition out there. And I can also, if I have hopefully a reoccurring product, I can show loyalty. Yeah, we'd love to see a lack of dependence on discounting. I feel like that's like the silliest thing for me to say right now because it is so hard for our e-com clients not to use discounting. It something we'd all love to get away from. It's very, I don't even, it's just not realistic right now. But it certainly is a characteristic we'd love to get away from. The other one that no one talks about is supply chain. So private equity, these professional buyers, they're looking at everything, right? Strategic buyers, they already have a supply chain. They're comfortable with their supply chain, right or wrong. It is what it is. Private equity says, boy, if you have 100% dependence, for example, on sourcing your goods out of China, what happens when we have a weather event? What happens when we have, probably not expecting another COVID event, but some other kind of logistic related event? What happens when we have a tariff, this or that? So having some kind of, at very least, a plan, even better, some kind of diversification in your supply chain makes that private equity acquire a lot more comfortable. The more comfortable they are, the more they'll pay, right? Risk brings down price, lack of risk increases it. So those are the very actionable characteristics today that often when we spend time with companies, we're working with them on these strategies. We love to see scenarios in which they're selling via their own website. It used to be like always the goal. It's not as 100% now on the goal. There are a lot of companies that really use their website as educational and then drive them to Amazon or other platforms for purchase. But there is still a lingering perception in private equity that the more you sell through your website, the more you control the customer, have that connection. And so we're a belief of we want to use the website at the very least to really demonstrate, independent of platform that they're actually buying on, really demonstrate customer interaction, be it through customer service, through product insights, however they're going to get through that. There needs to be something there, and private equity pays a premium for that.
Awesome. I love that. Those are some excellent, I think, goals. And I think that not only is this good business practice if you want to increase your valuation, but I think this is good business practices just in general. You talk about not being too dependent on one specific supplier for your products, because what if there's so many different issues? There's so many what ifs that could come up. What if their warehouse or their, manufacturing plant catches on fire? Or what if there's a tariff war? Or what if, there's, the shipping failures like in the Suez Canal? Like we've seen numerous issues that can clog things up. And so being able to pivot quickly, I think will not only help you stay in business, but be able to continue to capitalize on that. Being able to...
We're seeing, like, for example, we're seeing companies diversify their supply chain out of China and Cambodia into Guatemala. We're seeing fine goods come out of, Colombia. We see a lot moving into Mexico. And it's not that they're moving 100%. They're often they're starting to move some product lines. But it does. It creates a ton of value that may not be seen today. But boy, when that logistics issue comes up, it's a huge issue. And there's certainly some value in the agility, especially when you talk about product management. And we see an issue where when I have a shorter supply chain, I can respond to consumer consumer preferences much faster. I can order smaller lots, right? I can do a lot of things that allow me to look at how a certain line of dresses is selling, and maybe think about, boy, I'm seeing strange sizing issues, or I'm seeing color changes that I didn't expect. And I can change that mix because I'm manufacturing in Mexico and it's not going to sit on the water for X number of months.
Yeah, makes a lot of sense. Trever, I'm curious if when people come to you looking to sell their brand, as you start digging in, what mistakes do you see business owners making? They're like, oh man, I wish you wouldn't have done X, Y, or Z. What are some common things that you're seeing that, like, guys, if you could button this stuff up, like make your life 10 times easier?
Yeah. So the first one is the most boring one, which is poor data. And data comes in the form of, certainly accounting is the place to start, which is like the most boring thing we can talk about. But if you don't have good accounting, which often is the last thing as entrepreneurs we think about, right? Hey, money when it came in, right? I sold something, it came in. Why are you concerned about accounting? The reason is I'm talking about a third party who's looking at us, and the only things they can know for sure with the greatest level of confidence is these external things like accounting, something I can show them, right? So it may be valuable to us because we intimately understand and live our businesses is very valuable to this third party. The next piece, though, in the data is really customer data. Is we find that there is a ton of value in being able to cut up that customer data. So there's a number of things we do sort of uniquely as a firm to maximize client sale price. One of the things we do is deep data models. Love doing cohort analysis on customers. Boy, look at this customer. What's the behavior? So we're looking at cost of customer acquisition. We're looking at the full basket cost. We're looking at the lifetime value. We're trying to cut this in 1,000 ways so that we can show these diamonds. So, for example, we have an expert on our team. This is his job, is to literally go through massive amounts of customer data and find those diamonds. And that diamond may be something like, boy, my B2B customers, once they are ordered from me 3 times, they are with me for another 5 years, 3 years, or what have you. Look at the average spend after I do X. So typically you would say that, well, for marketing purposes, we want this data. Well, I'll tell you, for sale purposes, I want this data. I want to say, by the way, did you notice that our customers, once they bought 2 things, buy exceptionally a lot more? And by the way, that's why I'm spending so much time on our websites putting informational videos there. That's why I'm doing this. So we'll look by product line, by customer type, by time. We want to see what that retention looks like, what that spend characteristic looks like. Data. If you don't capture it, if you don't have the systems to capture that data, it makes it really difficult. Luckily, a lot of the platforms today out there are exceptional, right? They have that kind of data, and we love it. So that's call it the more boring answer, but that's a lot of it. The piece though that I see that's most disappointing, honestly, is, and we talk about those 2 things. Here's the second thing that I think is really, if you hear anything, this is the second thing I think that they should take away is the biggest mistake is when companies are talking to a potential acquirer and they talk about their financials solely. What I mean by that is, so you get called by a buyer and they say to you, hey, can you talk? And they start falling in love with each other and they say, send me your financials. Great. You sign this NDA and you send them your financials. And then the next process they're going to do is they're going to ask you a bunch of follow-up questions and they're going to make you an offer. And then you're going to negotiate that offer, sign an LOI, and do the deal. That's the standard process. And if you don't know better, you're going to follow that process. And unfortunately, this is what most advisors will bring you through as well. They'll bring you through the standard process. They're not doing the things to or the business owner's not doing the things to maximize the value. So the number one mistake they're making is this sole focus on their financials. We have to give our financials out. We have to do that to the acquirer. They need to see it. But stopping there is a crime. What we want to do is say, great, I get attention to those financials. That's great. What I'd like to do, Mr. and Mrs. Acquirer, is start talking about Monday morning. Monday morning? What do you mean? I want to talk about the synergies, right? I want to talk about the synergies of how not only you're going to get our business and what it looks like, but how much money are you going to make in the next 3 to 5 years? That, in fact, is the only question that matters in the conversation. But what they've been trained to do is instead have this conversation that's only focused on your financials, which means it's just a criticism. So whenever you started in valuation, it's just a degradation from there. And by the way, they're professional buyers, so they're better suited at pointing out all your flaws than you are. And it's like, that cannot be the sole context because that's never going to set us up for a premium. What we want to do basically is do 3 things. We want to characterize what the synergies are. We want to quantify them, and we want to validate them. So that means that, boy, if you own, what I want to do is start this conversation where we're shifting away from, Trevor, tell me more about your margin here. great. I tell you all that. And then I shift to, I really want to talk about that synergy. Boy, if you owned us, you could sell your products to all our customers. Let's talk about that. And then, by the way, you can sell my products to all your customers. Let's talk about that. So those are two examples of those types of synergies. And often what happens is we ask the client, does the buyer understand your synergies? Oh, yeah. They understand it. Okay. And what we find out is they do. The buyer gets it at the PowerPoint level. They get it at the high conceptual idea. There's an opportunity here for us. What they don't do is the next piece is to quantify them. Okay, if you owned us, we think that you could sell our products to X percent of your clients in the first year. We think the average sale is going to be Y. We think that incremental gross profit is going to be this. Incremental profit contribution is going to be that. And they say, Trever. That seems a bit aggressive. You can't sell your products to 20% of our customers in year one. It's maybe 15%. Okay. But what happens is that's now a number we agree. They have confidence in that. And now we want to do the next thing, which is validate. We want to allow them to get the insights into, can you validate together that 15% estimation is right? That incremental profit contribution is right. And if I can do that, what I'm saying is you get my organic earnings. You get the value of synergy A, synergy B, and synergy C. And by the way, we've taken the time to look at this together so that their level of confidence and their belief is much higher. So what that means, instead of getting my $2 million of organic earnings, I'm now saying with a high degree of confidence, I think you're going to get $5 million of earnings within 24 months. Very, very different picture. So if they're trading at 10 times earnings, I'm saying basically you're going to get $50 million of shareholder value, $5 million times 10 times, $50 million of shareholder value with a very high degree of confidence within 24 months. What are you willing to pay for that? So I just framed it. Instead of I've got $2 million of EBITDA, tell me as little, try to find the price that is little as I'll accept, to I'm framing this up to showing your shareholders how much money they're going to make. And now I can logically justify you paying a premium. Point, Trever, I think that 7 times earnings is the high end of market, but I'm willing to pay 8 for this, or even 9, because I realize that paying $18 million for this company makes a ton of sense. Hell, I'll pay 10 because I'm making $50 million as shareholder. I'm only paying you 10.
Yeah.
Or 20. That's a no-brainer, right? $20 million to $50 million share. So that methodology, that oddly enough, that happens usually post LOI, usually in this diligence. And so the logical question is, why would you hold back the most compelling information post LOI and do it after the price is set? Why would you do that?
Yeah.
And the reason is because it's not the standard process. It's not efficient. The buyer's doing this math in their head anyways. They're doing it behind the curtains. I'm just helping them get more and more certain about it so they can logically justify paying the premium.
Trever, this is, I think, a huge mindset shift. And I guess my question is this: is that kind of the primary reason to come, if I'm a brand owner, is that the primary reason I work with somebody like yourself, to say, hey, help me, guide me through this so I can truly maximize the value when I'm ready to exit, so that you can help guide these conversations, tee them up to where, you don't get your standard multiple, you get a premium, and it's because you've had these conversations.
Yeah, I think it's characteristic. These are the type of methodologies that a good advisor can bring. The question, so that what used to be said is that the advisor makes the market. That's their job, is to make the market. That was what they always talked about. The value proposition of knowing the buyer is completely diminished. The reason being is you and I have Google and LinkedIn, and as business owners, we know we can do a Google search and figure out who's acquiring companies. And guess what? I can message them by LinkedIn, and they'll take my message just as much as they'll take anybody else's. So knowing the buyers, that value proposition is gone, despite what the advisors will say, right? Because everyone wants to hear, I know your buyers. I know your buyers. What they're really saying is, I know your industry and I know how to position companies like yours. That's an important characteristic. But what you really want is a advisor who's going to maximize price, maximize probability. Those are the two factors. The third one is minimize risk, but we're entrepreneurs. We don't think about this. So it's really about maximize price. And the question you have to ask your advisor, you want to ask them as you're going through the process, tell me all about the deals like mine you've done, which is great. But that's really not valuable once you understand that they're an industry expert. The best question you get asked this advisor is, tell me what you are uniquely going to do to maximize my value and maximize my probability. That's what I want to know. Those are the keys. So it's things like what we just talked about, we call post-acquisition economics, shifting that conversation away from a criticism of my financials and talking about how much money are you going to make in the next 3 to 5 years. It's thoughtfully running a process with really engaged advisors. That may be starting with a global set of potential buyers and aggressively disqualifying it. It may be starting with one. I'm amazed. What often happens right now in 50% of transactions that are going on is you get a call from somebody and your decision is, do I just talk to them? Do I talk to a few, or do I run a process? And half those situations, they're talking with one buyer. So Mr. Advisor, why should I hire you with one buyer? I'm a CEO, I can get a deal done. Why should I hire you if I'm talking to one buyer? Price and probability. That's it. Boy, what can you do? Well, I can help you maximize the hell out of that price, make a really thoughtful choice. I can use things like deep data models. I can use things like post-acquisition economics. There's a number of other tools that we can use to maximize that. And that's from an advisor who's been in the space for 20 years, 15 years, right? An advisor that has been in the space for 5 years and may know the industry, but they're really not doing the most valuable thing, which is maximizing price and probability. The other thing they can do is this probability piece. It's really navigating the weird strangeness around selling your business. Boy, how do I talk to employees? How do I manage the fact that my buyer's getting weird on me on this issue? How do I have the strength to really ask for what I care about? Maybe it's exiting the business early. Maybe it's about, I don't want their earnout. I just want equity. In fact, I want to minimize. How do I deal with these things? The advisor has done this a good advisor has done this hundreds and hundreds of times. That's the kind of stuff I'm willing to pay for. My expectation is if you hire an advisor, your expectation should be, I want to get 5 to 10x the value comparatively to the fees I'm paying. I'll pay you a good number. I don't mind paying you a fair, reasonable market, payment for an advisor, but 5 to 10x measurable value is what I'm looking for. Increase in purchase price and increase in probability, which is a expected value calculation. Those are the two ways to do that. If your advisor can't convince you that they can uniquely do things, they're only going to run the standard process, you need to go talk to the next advisor.
That's brilliant. And I think on that note, in our previous podcast, we had Bill on, and he talked about whether it's finding an Amazon agency to help with your business, or whether it's finding a key employee to join your team whenever you're creating that partnership, which would definitely be the case if you're looking for an advisor to take your business to market. Date lots of people, right? And date lots of advisors. You need to set up a lot of different calls, and you need to have all of these tough questions that Trever just laid out. Say, how are you going to help me increase my value? How are you going to help me increase my probability? How are you going to identify the synergies? And go through those hard questions first, rather than just like, well, I heard this guy on one podcast, so I just signed up and I think he's a good dude. Like, go through, because there are going to be, the right advisor, and find the one that, obviously fits, the one that feels right to you. So I think that's also like good insight and words of wisdom, is just like, sometimes it's good, go talk to a lot of people, then come back, because this advisor can truly add millions into your pocket if done correctly. And on the flip side, you could lose millions if you settle for somebody that's less than ideal, so to speak.
Yeah, I'm a member of EO, Entrepreneurs Organization, and I had a CEO recently say something to me that I thought was brilliant. And I think it changed the way I started to think about this. He said, when you're trying to select a service provider or an advisor, ask the number one thing you can do to differentiate between the really, really good advisors and those that aren't great is to ask them, what how do you think I should select an advisor or a service provider? What for this particular thing? What should I be looking for? Advisors that service providers and advisors that really know their stuff will tell you exactly the most important factors. They're often different than the factors that you might think on the surface. In our industry, as I mentioned, it's like, boy, telling me all about the tombstones you've done in the industry. Okay. Just tell me you're an industry expert. Kind of prove it to me real quick. Check that box. Tell me about your process. Good advisors really talk about their process and can answer the question of what can you uniquely do. Right? That's how, and I started using that with other service providers as trying to select people. It's like, hey, tell me about how I should think about selecting someone that does what you do that's exceptional. And it's amazing to watch people glow who are really good. And those that aren't great, kind of new to it, kind of okay at what they do, their answers are all over the place. You can tell that they don't have it.
Yeah, I love that. That is another great recommendation. Now, Trever, as we wrap things up, I love to leave the audience with 3 actionable takeaways. So here's the action items that I've notated. Trever, let me know if you think I'm missing something here. But action item number 1, going back to your first comment, which is have a kind of a script or a plan for when people are reaching out to you, right? If you make the Inc. 5000 list, you'll get hit up a bunch, right? Yep. You cross that $10 million mark. You're going to get unsolicited people reaching out saying, hey, we want to buy your business. And so jumping on a quick call and explaining to them, look, I have a 3-year plan in place. I've got products X, Y, and Z that I'm going to be coming out with. Look, this is my buy now price, right?
Yep.
And so having that already, that then sets the floor. And guess what? Maybe they're just anxious and hungry for your brand. Maybe they're willing to pay that buy now price, which is a win for you because you didn't have to wait for those 3 years for that to come to fruition. Action item number 2 is going back to, before you even sign that LOI, can you possibly have that conversation to discuss the synergies about how, hey, when you acquire my brand, I know that you have X, Y, and Z brands in your portfolio. I think that you could sell our products to 20% of these guys in year 1. Adding that adds to the value stack so that the focus is no longer, hey, how do I trim down these guys' EBITDA number? It's more, you talked about maximizing the shareholder value there, saying this is going to bring 50 million. Now we're just talking about pennies at the end of the day if we're talking about $100,000 adjustment to their EBITDA, right?
Yeah, at maximum. I'm just shocked at how much value that methodology, if done well, can increase purchase price.
Yeah, I love that. And then last but not least, I think the third action item is selecting the right advisor with you. They are definitely worth their weight in gold. And I think we'll end with that last comment you made, which was you should ask them the question, how would you recommend or how would you make the decision of what advisor you would work with? And what should I be looking for as I interview all these different advisors? Don't just interview one and jump in bed with them. Like go through the gamut. Even though it's going to be a lot of upfront work, I promise it's worth it.
Try that trick with any advisor or any service provider you're hiring. It's a really fun trick. It seems almost like a Jedi mind trick, if you will, but it's amazing to see how quickly you can assess good service providers from others.
Yeah. So how do you think I should select the right PPC agency?
Yeah.
How do you think I should select the right, supply chain management, software, whatever it is? So
yep, that's exactly right.
Awesome. Trever, my favorite part of the podcast where I ask the following 3 questions to each guest. So number 1, what's been the most influential book that you've read and why?
So we run EOS in our company, Entrepreneurial Operating System. There is the first book in that process is a book called Traction by Gino Wickman. EOS is life-changing for business owners. I mean, it's one thing to we get incrementally better in our business or what have you. EOS is life-changing. And it is such because creates organization within the company. And yes, does it make us? It makes us much more effective, much more focused as a company. Our roles are clear. We're better at what we do. But the life-changing piece, it helps us as entrepreneurs focus on our highest best use. And that anxiety starts to come down. Now we get to focus on the part that we love, that we create the most value, and we're not getting up at 3 a.m. freaking out about all the things we should be thinking about. It's
Yep.
great.
I echo that book as well. Great recommendation.
Go ahead.
Question number 2 is, what is your favorite AI tool?
Yeah, got a really boring answer for this, but I find it to be very impactful. I don't use Google too much anymore for search engines. I use ChatGPT for all my searches, and I find the results to be tremendously different. And the reason is because I can add so much more context in the search. It is a differentiating tool. So we are very aggressive in our firm about using AI in the ways that we think adds the most value. You can't depend on it. It's not a crutch. It has to be an enabling tool. So that's the method I use. And as boring as it is, I've seen a lot of other neat tools out there. It is still my go-to.
Yeah. I love that as a unique way to, start your searches on ChatGPT rather than on Google. I like that approach. All right. Third and final question. Who is somebody that you admire or respect the most in the e-commerce space that other people should be following, and why?
Yeah. So in consumer e-com, there's a woman by the name of Deanne Akerson. She was the CEO at Kindred Bravely and then transitioned as she sold the business. We helped them sell it to TZP. Great transaction, really neat mix of cultures to see the acquirer just like love what the seller's business and help amplify that. But if you watch her videos, so she's talking about women's apparel, but you can see the care she takes. You can see the connection she creates with her customers. Look at her customer service policies. This is an example of a company that creates massive amounts of value far beyond just the earnings that they create by selling their product. This is a brand that has a lot of organic connection to their customers. That means that not only from an M&A perspective, people pay a lot more, but the reason they pay a lot more is because they can see how long the brand is going to last. Because it's not hey, I bought it because it's the cheapest. I bought it because it was convenient. It's I bought this product because I have developed a lot of trust with this company. And then guess what? Anything else they have to sell me, I'm in. So take a look at Kindred Bravely. Dan's videos are there. They're on YouTube. She is like incredible. She's like a Michael Jordan in e-com. She's amazing.
Love that recommendation. And always try and, the value definitely comes if you can charge a premium for your product. So great recommendation there. Trever, if people want to follow you, they want to reach out, where's the best place to do so?
Yeah, go to our website. We have a lot of resources there, objectiveibv.com. Tons of stuff we have 6 industry practices. So we have, I working on consumer practice, and in our tech practice, we have a lot on e-com there. So there's industry reports, there's other pieces, there are thought pieces out there. They can certainly reach out to it there. LinkedIn, we do a lot on LinkedIn. Our marketing team is very active there. The idea is give expecting nothing thereof, which is this idea that, look, help people without knowing that they're going to ever hire you, and life will be really positive. And so there's a ton of resources on LinkedIn and on our website.
Wonderful. Well, Trever, thanks so much for taking your time to join the podcast today.
Yeah. Is there's one other piece of advice I could give to on business owners? Don't be scared to call investment bankers. Some of them are going to be jerks and say, "Hey, are you ready to sell today?" And no, thanks so much. Most of them, they're going to take that call. The other thing you can do is talk to M&A experienced attorneys. These are not attorneys that have done it once. These are attorneys that are doing M&A all day. They will take an hour of their time and really help. And you may not be ready to sell today, and that's okay. But they are great resources. They want to help you. Give advisors like myself a call, or great M&A attorneys a call. They want to be resources for you.
That's awesome. And I would recommend that as well. Just jumping on the phone with somebody like Trever can definitely unlock one little mindset shift that can change the trajectory of your business. So, Trever, you dropped a lot of knowledge bombs on us today. Thanks again.
Love this stuff. Thanks so much, Josh.
Thank you for listening. Visit ecommbreakthrough.com for more information. If you've enjoyed today's episode, the best way you can show your appreciation is by clicking the subscribe button and quickly leaving a review. See you again next time.